I'm Katie Wesney, and I help my clients save hundreds and thousands of interest that they would otherwise pay back to the bank on their mortgage. How do we do that? By executing on a strategy that works with a plan. And that is the focus of tonight. Pure and simple. If you think that I'm going to talk about penny pinching, I'm going to give you hot stock tips. If you think we're going to obsess around interest rates, perfect length of fixing, the best bank, this is the wrong webinar for you. We are focusing on what works. So you've got me for 40 to 60 minutes tonight. We've got about 400 people registered. Some will join us tonight, some will watch a recording. You'll be sent this recording following this evening. I've got my amazing producer, Jess, in the background. We've collated all of your questions. I will answer them at the end, as well as any other questions you might have. So please use the chat box. I would love to help with anything. I am a straight talker. I do talk at pace, but please, if you want me to reiterate on anything, as I said, if you've got a question, please pop it in the chat box. So it enabled me lots to think about in this mortgage space at the moment. So we've got a tight agenda. We're going to talk about what is happening at the moment. I'm going to give you some stats that set the scene. Hope it makes you feel less alone. What are the forces that are working against us at the moment? And then we're going to focus on what really counts in terms of getting you and your family ahead, how to build wealth through leverage. I've got a great story to share with you, and then we're going to go through that Q&A. And at Enable Me, information hygiene is really important to us. I think it is a barrier for New Zealanders, particularly our younger generation, who digest lots of their information via TikTok. They get little inserts of strategy that is true in isolation, but not necessarily part of a broader picture that will work for them. So, who am I to talk to you tonight about finance? So, I am the head strategic coach at Enable Me. I have amazing clients, and I also head up an amazing team of coaches around the country. Background is I'm a chartered accountant. I trained at KPMG many moons ago now, and I'm also a qualified financial advisor. I've got 20 odd years in accounting, investment banking, and consulting. I've built and sold my own business. I've worked across obviously New Zealand, Europe, US, and New Zealand, and you would see me as a regular columnist on Stuff. As I said, been here for a decade. I'm hugely passionate about what we do here at Enable Me. We are in the business of changing lives, and I hope that journey starts for you tonight. A little bit of a disclaimer. Obviously, tonight is for information purposes only. I will throw as much at you as I possibly can in terms of information. It's just that everyone is different, and to be really impactful, you've got to be catching what's relevant to you. So in terms of tonight, I'm going off piece a little bit. I'm sneaking in a super special, of which I do not have permission to give, but giving it regardless. We'll go through that at the end. I'll ask for forgiveness later. So we'll have a wee special. If you do anything in this webinar resonates with you, you want to have a session with a qualified advisor about your situation, we'll have that wee offer at the end. So I'm looking forward to sharing that with you. So I want to be really targeted in my delivery tonight. And to do so, I need to know a little bit about you. So we've got a wee poll. Are you mortgage free? So do you not own your own home yet? No, I've got 20 to 30 years left, which is the average term in New Zealand. No, I have 5 to 20 years left on my term. I've got less than 5 years. I'm mortgage free in my home, but not in my investment properties. I am officially mortgage free. So if you could just take some time and just me that information, then I can again be really targeted in what I deliver today. In terms of the people that I have worked with over the last decade, my youngest client is 24, my oldest client is 84, and everyone in between. And so, age and stage, we work with everyone at Enable Me. So let's talk about our oh, polls in. Great. So for the vast majority, you've got that 20 to 30 years left on your term. So again, average mortgage term, it takes us 30 years to pay off your mortgage. So again, not alone. 3% officially mortgage free. Well done. A few don't own their own home yet. And we're going to help facilitate that as part of this journey. So I'd really admire you coming along tonight. There's going to be great information for you in terms of what you should focus on into the future as well. Right, okay, great information. I will ensure that I scope that into our session tonight. So let's be clear, our current mortgage reality in New Zealand, 49% of New Zealanders' income is going towards their mortgage. You've got to address it, you've got to be strategic. 59% of Kiwi mortgage holders are experiencing mortgage stress and pressure. 71% of mortgages are up for renewal in the next 12 months. When I see that stat, I think, right, let's get down to business and doing this better. 23 odd thousand have fallen behind on payments. And obviously, we've got this static about Trump, tariffs, market volatility. So that's what we're up against. But it Enable Me, and what I encourage all my clients to do is there are external factors, and we focus on the controllables. So, what does that look like? So, in terms of it being, and I often hear this with my clients, they're like, I feel like my parents or my grandparents had it easier. So, that's often what I get told in my office. And that is true to a point. So the average first home mortgages have increased from 300,000 to 550,000 within the last 10 years. That is a short period of time. It's increasingly getting harder and a lot more expensive to serve a mortgage. Not impossible though, but definitely harder. And all of us want financial security. That is an anchor for any financial strategy in any client I work with. They want security. They also want a little bit more financial freedom. Having a really solid mortgage strategy, paying it off faster than that average term, that gives you flexibility as to what comes next. It really does. And just to be very clear, if you catch nothing else in this webinar tonight, getting ahead is not about timing an interest rate drop. I've written about this. I talk about this a lot. We have a national obsession around interest rates. That is not the lever that gets you ahead. It really isn't. And that is the thing we need to watch out for at this time, because in our experience, when we go back, and we've been in this business for a very long time, so this is our 17th year, we have seen a lot, and Kiwis pay attention and they are more prone to take action when it's really hard. So GFC, people reach out to us in huge numbers. COVID, when interest rates are really high, but interest rates are coming down, thank goodness. This is your opportunity to make progress. Most Kiwis will squander it, they will get comfortable, and then not be where they should when interest rates rise in the future, because there's nothing surer than they will. We operate in an environment of cycles. So you just coming along today to digest this information, you are ahead of the curve. It's what you do with that information that will be a differentiator for success for you and your family. So The reality is we're paying too much interest on our mortgage, and we have really profitable banks in New Zealand. We need to clock that, and I would much rather that be money in your back pocket than given needlessly to a bank that is very profitable. And to me, I would much rather that interest saving be spent on a comfortable retirement, helping your children, great holidays, and living your best life versus paying it back needlessly to the bank. And I'm going to put some numbers around this to really bring it to life. So, again, it is not the interest rate that you pay that will get you ahead, it is the pace at which you pay it off. So, the difference early repayment can make average first home mortgage of 550,000 on a mortgage rate of 5.99%. If you pay it off over the average term, you repay 635,000. If you in interest, if you pay it off in 15 years, you pay 234,000. In 10 years, you pay 181,000 in interest. So the potential savings for you are 453,000 of money you do not have to pay back to the bank if you have a better strategy around that mortgage. That is what I want for you, and that is what we unlock for our clients at Enable Me. And if your mortgage is high, if you're sitting back saying, well, is this even possible? I've got a high mortgage. And again, not alone. Lots of our clients have high mortgages, over $1 million, very common for our clients. So this is a $850,000 mortgage. It just means we can save you more, if I'm honest. So same dynamics in terms of interest rate, but the difference between 30 years and 10 years paying off a debt, which is our benchmark at Enable Me. It is not average. Our benchmark at Enable Me, having a good strategy that you execute on saves you $700,000 of interest you do not have to pay back to the bank. So this isn't some Ponzi scheme. This is not about trying to time the share market. It is not saying this is reliant on you working with a particular bank. This is having a better mortgage strategy and structure that will serve you into the future. This is what you need to focus on. If it was easy, everyone would be doing it, and they're not. And there are rules around all of this. I need you to understand those rules. We execute on them, and then your trajectory will shift. And there's lots of things that feed into this. And another really important thing to clock is that earning more money is often the thing that people also anchor themselves to. But in all reality, the experience for most is the more that you earn, the more that you spend, and the more you disconnect from your finances. And earning more does not necessarily translate to more progress. Generally, it's more stress, time away from the family, you have a bigger engine, and you're working really, really, really hard to maintain that engine. So at Enable Me, we believe financial success comes down to two things: 80% behavior, 20% is strategy. Generally speaking, for the vast majority of people I see, and I work with amazing people from all walks of life, it is that behavioral piece, the doing of the thing that feeds into this, knowing what will work for you, and we apply the strategy that will work with your personality. That is the thing, that is the secret sauce in terms of getting ahead. So I'm going to help you diagnose that within this session today. So, in terms of crafting a really clear plan that works, you've got to understand your starting point. And often that's really critical, and often it's really hard to do a self assessment on that. And I think often that is the beauty of working with somebody else to get that really accurate diagnosis of where you're at. But you've got to start there. You've got to really understand, well, what is the problem you're looking to solve? If you keep on doing what you're doing, is there a gap in terms of your retirement strategy? Are you trying to retire early? Are you trying to just get on the property ladder? What is the problem we're trying to solve? Because that's our anchor point in terms of the strategies that will work for you. Time is super important. It is one of our most precious commodities. And I don't take it lightly that you are sharing this evening with me today. So I am going to be really targeted and pointed tonight. And how you operate around money, your natural tendencies, that plays into the language that I use with you and what I know will work and make sure that you sustain an action. Because just doing something once is not going to change your trajectory. It's that consistency of action that really counts. And obviously, everyone's dealt different hands in life. We acknowledge that. We understand, well, what is your opening hand? How do we play that to the best of our ability? And for me, it comes down to three, well, I actually would say four pillars, if I'm honest with you, with me and my clients. For the vast majority of people, I will anchor your plan to four pillars. First pillar is let's maximize that cash surplus or your savings or the cash that's left over. That's the engine room. We're going to unpack this soon. Secondly, we're just going to crush that mortgage. We're just going to get rid of it. And thirdly, we grow wealth. And for you, like for me, likely we need a concurrent strategy where we clear debt and grow wealth at the same time to land where we need to. And that fourth pillar is we create financially independent children if we have them. That is really important to me. It's part of the drivers of what I do. I have three children, and I really need to know that our children know these rules and they hit the ground running. And I also know that it's what they learn from us that often is the thing that will be their kryptonite into the future. It really is. So let's take a deeper dive. How do we do that though? Hold my beer. So in terms of maximizing your savings, so at Enable Me, we were built as part of the legacy that Hannah McQueen has built for us. And part of that legacy is we have a mortgage optimization calculation that we use for our clients. But what we understand to be true at a very grassroots level is that just because you have a perfect formula that shows you how to structure a mortgage, you need to have extra cash left over to chuck at said mortgage to ensure you can pay it off faster than the minimum amount required. So understanding what you are capable of from a cash flow perspective is really important. And lots of things play into that in terms of who you are, who you're not. And in terms of money personality, we spend a little bit of time diagnosing that with our clients initially. And you think about who you are. If you have a partner, you can judge them because that will play into your strategy as well. And that comes down to shopper, saver, plotter. So I am a shopper. I derive emotional satisfaction from shopping. So again, I don't judge in my role. My husband is more a saver. He derives emotional satisfaction from saving. And a plotter is neither here nor there around money. So they don't particularly enjoy spending money, but they're not super great at saving. So somewhere in between. And when you look at that, you think, well, if you're a saver, you must be a sitter for making progress financially. Not quite true. In my experiences, savers are really good at amassing cash flow or cash, but you can't save yourself to wealth. So whilst they're good at accumulating cash, they're not so good at growing it in terms of taking on risk and doing what needs to be done. And just to be very clear, you cannot save yourself to wealth. So, again, understanding your tendency, we need to work with that to make sure that you're brave enough and you understand, well, what risk do you need to take on to land where you need to? And often that is about assessing, particularly for my savers, the opportunity cost of doing nothing, because that's really important to clock. And it helps us to be braver in terms of strategy. And with a shopper in the mix, generally speaking, we need to have goals that are sexy enough and motivating enough for us to try harder. And we love to see visibility around progress. That is motivating. And so we massage that in terms of risk, and we understand at that base level, where are you starting from? So most of my clients are floating. They're fine, but they're not making the financial progress they deserve. So flying, I would define as saving or having cash flow of at least 20% of what's coming in is left over. Thinking you are sinking if you have no surplus or funds left over. I would also classify you as sinking if you cannot pay off your credit card in full. Lots of people think if they're just paying the minimum amount on their credit cards, they're floating. I disagree. I think that is evidence of past overspending that you're trying to course correct on. So, again, understanding where your starting point is, what those natural tendencies, that helps define the strategy that will work for you. And knowing those tendencies helps optimize that cash flow. And what I know to be true is that on average in New Zealand, we fritter about 15% of our net income in terms of spending that makes us no happier. And I can give you an example, coffee. So me and coffee, that first cup of the day, I am riding that caffeine wave. Second cup, not quite as good as the first, but still pretty good. Third cup, I tend to feel a bit sick. So my optimal level of coffee drinking is 1.5 cups. Anything over and above that, I'm just doing it for the sake of it. And we fritter across lots of things that we do. Lots of it is around food, subscriptions. Mortgage structure is a huge area of fritter for the clients I see initially in terms of paying too much interest to the bank, not looking at utilities, bank fees. This all feeds into the sluggishness around cash flow. Often the clients I see, they are comfortably inefficient. They're fine, but again, they are not making the financial progress they deserve. So again, if you know what hits your bank account, if you're single, you and your partner, write it down, times it by 0.15. That is the amount that you are frittering per fortnight, per week, per month. That is the money that I will find you and put to better use in terms of accelerating the pace at which you pay off your mortgage or grow wealth. Maximizing savings includes getting rid of scrappy short-term debt. Don't use credit cards. Don't. Lots of people argue with me. You don't understand. I pay them off in full. I'm winning. I get points. We know from a behavioral economics principle, if you put something on credit, you spend more because just by using that mechanism, it disconnects you from your finances and it's easier to spend money. I promise you, even if you pay it off in full, if you don't use credit cards, you will do better. Try it out for a month. And what I don't like about credit cards is I don't want your children to be watching you just merely tip tap tapping things on credit card. It's certainly not what I want for my children. My daughter's off to uni next year. She won't be getting a credit card, I tell you. And remember, they are watching everything that we do, and we are their first teachers around money. Don't use credit card, you'll do better. And for me, often with my clients, and I saw one yesterday, their credit card has been their buffer, and it is a non-negotiable for me that we embed within your structure a really good buffer. And what is a really good buffer? That's 3 to 6 months of expenditure, but let's be clever around what that looks like. So ideally, that buffer sits within that mortgage structure versus in savings, because that doesn't make sense to me either. Because if you have a mortgage, why would you have savings? You always pay more interest in debt than you receive in savings, and we just get rid of that short-term debt. And that might be via a top up. It might be. Let's understand your position. This is not individualized advice, but we've just got to get rid of it. It's just a drag in terms of what you could do into the future. Crushing that mortgage, really important. But what you've got to clock as well, that there is productive debt and non-productive debt. What do I mean by that? We always focus on debt associated with the home first because there's no tax deduction associated with that versus any debt associated with an investment like a property or a business. So we always focus on that unproductive debt first. And just to reiterate again, I don't care what interest rate you pay. I want you to pay the lowest amount. Of course I do. But what will make this work for you is increasing the pace at which you pay it off. And I think that lots of people can relate to this because often when we think about the good old days, well, were they good? I don't know. COVID was horrid. But when interest rates were 2 and 3%, were you paying off your mortgage faster or were you spending that excess cash on other things? That's the thing that you've got to ask yourself. And again, having that refined strategy around that mortgage can be really protective. It can create buffers, but it can unlock other opportunities. So that's what I want us to focus on with our clients. And in terms of if you've got a piece of your mortgage coming off, often we're looking at, well, do I refix that portion of mortgage for a period of time? Should I refinance that mortgage? And again, if all of your mortgage is coming up for renewal, I would really be encouraging you to think about whether that's in your best interest. Often it is. You can get about often 0.8% of a cashback to do that, and it's a chance to reset that structure. You don't have to, it's not the thing that makes it work. But again, we're trying to get some wins on the board in terms of you having that strategy. So definitely something to think about. Not a must do, but again, just something to think about. And often it's about restructuring what you have to ensure that it works and serves you better into the future. In terms of that optimal mortgage structure, so what that looks like for our clients, it's like 8 pages of calculus. Most people's eyes glaze over at this point. But essentially, what it does is it cuts that mortgage into savings or debt reduction goals. So every year, you've got a piece you can attack over and above what the bank wants you to do on your terms, not their terms. Really important. Generally speaking, it doesn't mean that we necessarily increase the pace at which we pay off a fixed term by increasing the monthly amount and arbitrarily shortening the term. For lots of my clients, I like using that revolving credit mechanism, which would equate to what they could save over and above the minimum mortgage repayment and anything they could offset. And sometimes it takes people a little bit of time to get their head around a revolving credit. If you haven't heard about it, effectively, it's a portion of your mortgage that is floating. It is like a really big overdraft, essentially. So you could have 20,000 in your revolving credit, which means that you owe 20,000 to the bank, but it sits in a floating account. So you might have, say, 10,000 in savings. You could plonk that into your revolving credit account that would offset that 20,000 by 10,000 immediately. So that balance would go from 20 to you owing 10. You could draw up to that 20,000 if you needed it. So you have a $10,000 buffer, but you've immediately offset debt. I really like that. And your job would be to try and pay off the rest of that balance within a calendar year. What most people get wrong with that revolving credit, in my experience, is they float too much. And you've got to be careful. That's why lots of people call it a revolving credit. Why is that? Again, they float too much. And you're paying a floating interest rate on that balance, which is about 1.5% higher than you would fix. So you've got to be strategic around what you do with that account. And often people will attach it to a credit card, which makes sense mathematically. It does not make sense behaviorally, though. Try and say that fast. And why do I say that? So for often people, they float too much, that they're paying a little bit more than they should in terms of interest rate. They often have their salaries going into a revolving credit. So the salaries come in, offsetting the revolving credit, and they think, oh, check me out, making progress on my mortgage. They put all of their spending, thinking they're clever, getting points, must be winning. But then they spend a little bit more than they intended on the credit card. They pay off the credit card. They're floating where they always have been. Even worse, maybe edging into that revolving credit balance, and they never quite make it work. But along the way, they spend too much and they pay more interest than they should. So that's what lots of people do. So you've got to make sure you're clinical around that, and you've got to make sure, in my experience, that you have really good support structures of control around that. So again, for me and my clients, we get really nuggety in terms of bank account structure to make sure that we ring fence cash flow. We know where things are at and we make really good decisions. We're not feeling guilty about spend, but we've got that feedback loop in terms of intention and strategy. And that account structure is exactly what I teach my kids to do. It's exactly what my Bella will be doing next year at university at Otago. It's exactly what me and my husband will do in retirement, which hopefully will be sooner rather than later in terms of our journey. So again, having that really solid baseline, making sure you're really clear on structure is important. So often people will say to me, yeah, yada, yada, I prefer an offset mortgage. I disagree respectfully for most of my clients. And why is that? So I'll give you an example. I have these clients come in periodically. I think for these clients, their mortgage was about 300,000, and then they had 300,000 in offset floating, so that's what they owed, and they had 300,000 in savings. And they're like, well, effectively we're mortgage free, which I they're not mortgage free. Certainly their mortgage is fully offset, so they're not paying any interest, but they're still paying that $300,000 off over the remaining term, which for them was about 12 years. And that makes zero sense to me, because why would you be paying something off that you wasn't incurring interest? I would much rather you be investing that or paying off interest-bearing debt, which is again a great pro of the revolving credit, because if it's fully offset, there's no cash flow associated with it. So again, it's about how do we sharpen the axe and understand what's right for you. And again, this is just pictorially, we like to see things in pictures as well. So ideally what we see in the revolving credit is what you can save or offset in a calendar year. And then we fix the remaining amount in accordance to goals or what comes next. And that is client dependent. You know, back in the day, you could look back, and hindsight's an amazing thing, but you could win if you just rolling fixed for a year. But that came to a point where no one won when we had the higher interest rates. That is not true in this environment. So that's the nuances of everyone's situation and understanding what's right for you. And again, just to be very clear, don't catch the message that this is cookie cutter, because it's not, nor catch the message that this is linear, because life's not linear. I love that saying. I think it's a Mike Tyson saying something about everyone has a plan until they get punched in the face. And again, I've been at Enable Me for a decade now. I've seen, I've just worked with thousands of people, and I've seen clients get punched in the face in so many different ways. COVID was particularly jarring for my clients. I've always worked with lots of pilots, etc., which really was jarring in COVID, I tell you. But having a plan, doing what you need to do when the sun is shining, and if we have interest rates in the fours, if you have a job, the sun is shining, whether you like to admit it or not. If you are waiting for the interest rates to get down to 2, 3%, you're waiting a very long time. And if they did, we have bigger problems at play, I tell you. So again, it's not about waiting to perfect conditions. There's nothing more perfect than today, but it's ensuring you do what needs to be done, that you are strategic, that you have a plan that's right for you. That is the thing that will get you ahead. Is it lock and leave? Certainly not. If you had a plan that was set in concrete, it would become irrelevant to you, but you got to have a plan that's flexible. That's why you have good buffers, because it means that you can absorb shocks and you can hold your line. And plot twist, being mortgage free. It's great. It really is. I love not having a mortgage because I walk the talk, because I think people sniff hypocrisy. And again, that comes down to that information hygiene. You work with people you trust, you work with people who know their stuff. And being mortgage free is not the end game in terms of finances. It is great. We ring a bell at Enable Me. We get so excited. We'll send you a bottle of champagne. We will, but there's more to this than that. And for us and our clients, being mortgage free unlocks opportunities to do other things to really turbocharge wealth creation. And for lots of people, that looks to be that leverage piece in terms of you're paying down a mortgage, you're creating equity that sits within that property. Often people tap into that to buy another appreciating asset to give them a bigger landing pad in terms of retirement and wealth creation. And again, often people will say, well, has property had its day? You know, we've seen exponential gains. Remember, everything is a cycle. If you go back in the sands of time, everyone's always saying, in the 80s, they were saying, I feel like property's had its time in the sun. But in reality, we always need shelter. It's one of our hierarchy of needs, and land is scarce. In terms of property, just to be very clear, as a wealth creation strategy, it is not that property gives you exponential gains. It really doesn't. The beauty around property is that leverage piece. And because you're using leverage, that you're borrowing money to acquire a bigger asset, it outperforms other asset classes by 250%. Not because it's amazing, it's just because you've acquired a bigger asset than you would otherwise. And it has less volatility than other assets when you look back historically. And again, no one has a crystal ball. I don't have a crystal ball. You don't have a crystal ball, but we're working on knowns and we're working on what we know helps. And again, there is a cost to inaction in all of this as well. And you've got to clock that. And so that step 3 is really leaning into that leverage piece. And I always give this example to clients. You know, you could have 100,000 and you could put it in managed funds. You could get an amazing return on that. 10% could go down, but let's say 100,000 at 10% versus you take that same 100,000 as a deposit on a $500,000 property, you get gains on 500 versus 100. That is the beauty around property. You got to buy the right one though, and you have to have the ability to hold it. So that's part of the finer details of that financial plan, ensuring that we're crafting a strategy that is right for you and your family that you can maintain. So I wanted to share with you a client story to kind of really bring this to life. And so these are lovely clients, Luke and Jake. Met way back in 2017 in their mid-30s, so young. Mortgage of 700K, initial term 30 years. Vast majority of people just tracking to that longer term. Um, we said to them, working with us, being strategic, making sure that mortgage is structured correctly, let's clean up inefficiencies. We think that we can get you mortgage free in 12 years. What they've actually done with us over the last 4 years is because again, life's not linear, right? They have purchased a car, they renovated their home, they got married, they traveled overseas, they've actually purchased 2 investment properties, they've had some employment setbacks, redundancies, etc. We got them mortgage free in 2021, but they've done all these other things. Because if you're going to do this right, you're going to do this really well and you're going to bank results. That is what we're here to facilitate for our clients. And in terms of bringing this to life, and obviously I've got chartered accountant blood, love a good graph. So we've got some graphs coming up. Bear with, bear with. So on average, we buy our first home in New Zealand, and it changes by a few years, but it's around 34, 35 that generally the data shows we buy our first home, and then it takes us 30 years to pay off said mortgage. That is unacceptable to me, and it's why I do the job that I do, because I will not accept that for my clients. So, in terms of looking at, well, why would I bother having a good mortgage strategy? Why should it count? It counts because for most people, they get mortgage free at 65, which is an achievement. You cannot say it's not, but it means that they run out of money really quickly because their KiwiSaver is great to a point, but they need to be doing something else. In this example, they run out of money at 69. So it works so hard to run out of money at 69, not on my watch. So again, if we can get your mortgage free faster, in this example at 55 versus 65, it just means you can save more. There's no tricks around this, which means that you run out of money later. With my clients, I'm trying to get them to at least 90, 100 preferably, but at least 90, and getting them their money to last till 80, whilst great, I'm still going to do something else with them because actually I need a bigger landing pad for them into the future. But that again, I'm trying to show you the impact of having that concrete mortgage strategy that works. It is a game changer. Am I saying it's the only thing you do? Certainly not, but it is a really big lever you pull to have that really solid foundation into the future. And again, just distilling with you what that good plan looks like. We understand the problem to be solved. We understand your tendencies. You know, we talked about that shopper piece. What are the things that will speak to you to make sure that you can sustain this strategy? We want to remove inefficiencies. Stop paying too much interest to the bank. Just stop it. Stop using banking mechanisms that don't serve you and create better systems. I love that saying, you never rise to the level of your goals, you fall to the level of your systems. And part of that system structure for my clients is around that bank account piece. We want to be really directive. We want to force your hand, make sure that you had feedback loops within there and developing that wealth mindset. I remember, I'll never forget, I, s- I had a session with a really successful, he was American, forgiven, and she was Kiwi. And I said to them, yep, so I came along. I think their mortgage trajectory was about 24 years. I was like, yep, cool, cool. I'm going to do it in 8. And this is how we'll do it. And he was like, Katie, did the banks let you do this? Is this legal? I don't know what kind of vibes I give off, but I'm like, absolutely. But again, it's who you surround yourself with, knowing the rules and executing on said rules, really important. And that is a trap for lots of people because there is a difference between knowing and doing the right thing at the right time. That is the devil in the detail. And it's amazing that you've come along tonight. I really applaud that. But you need to focus on the actions that you are going to focus on that is going to move the dial for you and your family, and it's not lock and leave. We've got to adjust as life happens to us, things change. We've got to adjust that strategy to make sure that you can absorb those changes. And for lots of my clients, it is tough right now. They are bleeding money in terms of cost of living, uncertainty around jobs. I get that, but it doesn't mean we do nothing. It doesn't. It means we actually lean in harder and we do what needs to be done now versus waiting because the stars never align. It's about taking really good, clear action today. And of course, this is what I'm trying to facilitate for my clients. Remember, I said I want to get them to at least 90 in terms of living their best life, because this is never about living a small life. It's saying, well, how do I live my best life and make sure that I have more choice and I don't have to worry about money? And in terms of numbers, if your retirement gap is bigger than 300,000, likely you'll need to use leverage to bridge it. And often I get it. People are like, well, I don't want to buy property. I don't want to be a landlord. No one buys property to be landlords. Lots of people say to me, yeah, but that feels like a mission. And I don't want to take properties away from first home buyers. That is not what I'm saying. I'm saying be deliberate, make sure that you look after your family. And for my clients, they're buying new build properties, which we so desperately need, well insulated in terms of making sure they craft an ethical strategy that will work for them, but also help others. And I love that about what we do. It enable me. And knowing your number is really important. And knowing that number for me comes down to what does it cost you to live a happy life? And that happy life is different in terms of all the clients I see. So everyone's number is different. You've got to understand, well, what is your number? And how do we make sure that we facilitate that lifestyle cost when you no longer work? And you're able to facilitate that if you clear debt and you grow wealth so that you can feed that lifestyle when you no longer work. That's a really important anchor point, and you got to know that. And if you don't know how to do it, you need to get help because there are very clever financial advisors who can help figure that out for you, of which I am only one of. And often I find with my clients, of course, I know structure, of course, I know strategy, but often when you're working with somebody else, it's that external accountability that is the differentiator. You do what needs to be done, you lift your game, and you get better results. Of course, you do. That's just natural. And lots of great quotes there. Working hard is important, but working on the right thing is more important. A great strategy can deliver exponential results. And remember, we're not in the financial business. We are in the business of changing lives. How do you do that? You do that by having a great strategy and plan that works for you, making sure that you pay off that mortgage associated with your home as fast as possible is a really important anchor point. It is not impossible. The averages I do not accept. I do not accept them every day, and I haven't accepted them for the last 10 years with my clients, nor should you, but you have to take action. Another powerful quote. We love a good quote, and they will be. But I want to get to those questions. So, key takeaways: lower interest rates are great, but on their own, they won't get you ahead because likely you'll just spend that on other things which do not get you ahead. Understand your tendencies and capacity and how this feeds your strategy. Cases where the gains are to be made. Knowing does not equal doing. That is what you focus on and never lock and leave. And for us, that accountability piece means that you do better. And nobody works with me to be fine. They work with me because they're ambitious and they want to make the most of their position. So I am very proud to lead a very extensive team across New Zealand. So the sea of faces are all the faces who could help you on your journey. And I said I was going to go rogue, and I want to ensure you take action. So I have a wee offer for you tonight, which is actually better than the one that I was authorized initially to make. So I would love if anything resonates with you, if you want to jump on the financial scales, if you want to have an initial financial strategy session with us to figure out where you're at now, where do you want to be? Are you on track or could you do better strategically? I would really encourage you to come along to initial 90-minute strategy session with myself or one of our amazing coaches. So the discount I was authorized to give, so that 90-minute session, lots of people do it via video, face to face. We're all up and down the country. That generally is a cost of $400. I was authorized to give you a discount of 149 if you book before the 30th of June. I'm going to do better than that because I think this is a really important juncture for people to take action. I'll beg for forgiveness tomorrow. I'd like to offer listeners tonight, and if you rewatch this before Friday close of play, I'd like to offer you an initial discount with me or one of my amazing team for $99. So that's usually 400. I was authorized for 149. I'm going to go with 99. Jess is probably on the line, my producer, thinking, where she's gone rogue. But let's go through those questions. To take advantage of that offer, that $99, you just have to reach out to us by close of play Friday. Otherwise, we'll have that 149 offer for you if you watch this recording afterwards. So $99, just make sure you say that you listened to Katie and get that, scan that QR code thing by Friday. So Jess, questions, hit me.
Thank you so much for your time, Katie. And yes,
She's like, what have you done? What have you
I'm sure
done?
you'll be forgiven. Okay, let's quick fire. Let's fit some
Okay, go.
questions in.
Hit
Hot
me.
topic. I was told now not is a great time to buy a second property given the economy, the world economy, tariffs, faltering international relationships, and with the current government flipping the switch every 5 seconds. I was told to hold off. So what is your view on this, Katie?
I think if you can, you should. And obviously, that is dependent on your own situation. But again, what are you waiting for? Prices to increase? Because that'll just be more expensive. And I think often, and again, we'd have to assess your situation, but generally speaking, if you acquire an asset sooner, it means that you have a longer period that you can hold it. Therefore, you can afford to take a less risk. You know, if you wait maybe 5, 10 years, it means the gap towards retirement or the length of time is shorter, which means you need to take on more risk to sort that in terms of retirement. So I'd be really encouraging you to look at that sooner rather than later. Next, Jess.
Thank you so much. Can we backtrack back to how the revolving credit
Yes,
works?
yep,
So,
yep,
so
back.
the question that's come through is it's not the question. I'll just read it out. So, would
Great.
we then utilize flexi mortgage? May have told me to put my savings into my mortgage, but worry that if something comes up, I won't be able to have any money, and then we'll need an additional mortgage.
Yeah, no, good point. And flexi, the terminology flexi is used by ANZ. That's their revolving credit mechanism. And uh, the key thing to catch is it's a non-negotiable for me that you have a good buffer. We will instill that in your strategy. But what I'm saying is, if you have savings, I'd much rather they be offsetting the debt on the proviso you can reaccess them. That's the only reason why I want you to be using those savings likely against the mortgage on the proviso you can reaccess it. So that's the key point to catch. Next, Jess.
Thank you. Can you talk through the value of a coach? Like, could we not just figure this stuff out ourselves?
Yep, you absolutely could, but it'll just take you longer. What I liken it to is um, going to the gym. So I have a personal trainer at the gym. I've got a program, and again, they encourage me. I show up. I am more consistent. I've got a plan crafted for me, so my time is utilized really well. So the beauty of a coach is they know what works. They're really efficient with your time and they will get better results for you. So, sure, you could figure it out, but at what cost to you and how long will it take? And will you be smarter than me and know all that I do? So, again, that is my challenge to you. Next.
Thank you, Katie. This one's a good one around balance. So, should I use my money to buy an investment property or push it to pay off my home mortgage sooner?
Oh, such a great question. And again, remember we talked about ordering, and obviously I need to know your personal situation, goals, age and stage, etc., access to lending. But fundamentally, for most people, we would say, well, likely we'd prioritize you putting that money against your home mortgage. If we can re-access some of that via that structure, all the better. So we reduce unproductive debt and then we use the equity that we're creating in that family home to tap into that to buy another property. So that debt sits against the investment, which means that it's deductible, which means it's more efficient and effective for you from a tax and an interest perspective. So, great question. And I caveat that I don't know your personal situation, but those are generally the rules that I encourage my clients to look at when we assess their situation.
Thank you so much,
Lucky
Katie.
last, can we do one more, Jess? I think we
Yes, I
can.
think we can. Yes. Um, so, so can you hear me still?
Yep, perfect.
Okay, cool. Um, I have a mortgage that's up for renewal in a year. Would you
Yep.
suggest I break that so I can access the lower interest rates today?
Yeah, so the first things first, let's figure out the break cost associated with that. So, what I'd encourage you to do is ring up the bank and ask them how much it would cost you to break the mortgage. And then we could figure out together, well, would it be more advantageous to you to secure a lower interest rate? But we need to take into account that break cost. And often, as part of that conversation, and things that you should be thinking about is often you can negate some of that cost if you refinance to another bank and you get that cash back, which is generally 0.8%. So these are the conversations we'd be having in terms of what's the best piece of mortgage advice for you. And it's always as part of that broader plan in terms of making sure that we sort you for retirement and that we make sure you're not unnecessarily exposed.
Thank you so much, Katie. Apologies to everyone. We have ran out to answer your questions. Love to hear that some of you are sold. If you have further questions around how the program works, what it costs, our onboarding team will be gladly available to answer your questions tomorrow. So please give us a call or an email. But I will leave it to you, Katie, to close.
Great. So I really hope you've enjoyed this session. I hope there's some really key takeouts for you. Again, I'm really thrilled that I could naughtily offer you that $99 consultation with myself or one of my amazing coaches. It'll change your life. I know it. So be brave, jump on the scales, understand how much better you could be strategically. I wish you all the best and we look forward to seeing you. Take care.